Okay, good afternoon, everyone. I hope everyone can hear me. Basically, my name's Steve Torsa. I'm the founder and managing director of Wholesale Investor. Some of you I probably would have met before at some of our events. And, really, we've actually been doing this workshop now across a whole, but, I think for really the last sort of 4 months, and we've done it across Australia, Singapore, and the UK. And the feedback has always been quite overwhelmingly positive. So I thought, as we're sort of setting up, as most of us as founders and, sort of deal makers, I suppose we're setting up for the new year. And typically, raising capital is on a lot of people's agendas. And so what I really want to do is just host this webinar and provide you with some, I suppose, insights as to not only my own experiences, but also some of the experiences of the companies that we get to work with. And more than that, this is, and I'll make this sort of really clear from the start, this is not about me talking about how amazing I am at raising capital and why you should do exactly. It is more, I'm taking you through every mistake, or not every, but I'm taking you through as many of the mistakes that I've made as possible and what you can do to avoid them more than that. And, I'm fairly candid in this from from my own sort of personal experience, and also sort of highlighting the mistakes I made, highlighting some of the mistakes that I've seen other people make. And it's more so that you can avoid that yourself. But then also, how do you actually set yourself up for your own sort of best practices and know what to experience? And I think that's the other part. The other part that's really frustrated me is sort of more and more I speak with different people about raising capital. There's a lot of things that are not spoken about. And I said, I want to provide this as a platform to do that. And also to let you know that what you're about to experience in the capital raising journey is completely normal. Right? Because it is actually quite an emotional process and no one talks about it. And also, if the investors and advisors that are on the webinar, don't take offense, but, we get told different things by advisors and by investors, which are sometimes completely inaccurate, and they know this themselves. But however, it's just part of the positioning and part of the game. And you've got to realize that the raising capital is a game. Fundamentally, raising capital is a marketing and a sales exercise. And the only difference is it's just something we're super passionate about, which is our own business, and that's what makes it so much harder for people, as they go through this journey. But really, that's all it is. So I hope you enjoy the webinar. It will go for approximately 90 minutes. Now, there is an ability to ask questions through it as we go through. I will have one of my team communicating with me via WhatsApp at that time. So if you hear me break for some reason, that's probably why. I'm sort of, obviously going through my presentation, but also, seeing if there's any messages coming through at the same time. So with that note, we'll sort of kick off and hope you enjoy the webinar. So first step is, basically with the things that we're going to be going through with the webinar, it's just the capital raising process. So first one will be the reality. Second one will be the core principles that we sort of encourage companies to work from. Third step will be the attitude that's required. And this is a massive part. Like, attitude is everything when you're going through the capital raising part, because as I said, it absolutely isn't an emotional process. The 7-step process that we encourage companies to utilize as they're going through this process. Common mistakes founders make. And I think that's a big one. And also common mistakes I've made. I said I will be going through all the mistakes I've made, and also I'll be even going through my rejections. And the reason why I go through my rejections is not because it feels so good for me to talk about it. It's more because I want you to understand that this is what you're about to go through, and it's completely normal, right? Whereas other people may make you feel like, oh, it's unique to you, but I can assure you it's absolutely not. This is all a dance. Okay, so the first step is the reality. Now, whenever we deal with companies that are about to be going through a capital raising process, effectively where they actually start out is, they start out in a different way. And as I said, there's a whole bunch of emotions that go through this. But the way everyone always starts out is overconfident. So you would not believe how many people actually call up our office and say, oh, look, we're starting off a capital raise. We only want investors coming in for minimum $500,000 check size, and we want to complete it in the next 1 to 2 months. And the reality is this is just, and I said, normally I would get people to sort of, when I'm doing a workshop, I'll get people to raise their hands who's been able to raise capital within a 2-month time frame from start to finish. And you find literally there'll be one person that puts up their hand. More than that, when I ask who has been able to actually have an investor put in a $500,000 investment from a first-time investment, straight off the bat, said it'll be about the same. You know, it's really rare, right? So we always start out, and this is me as well, we always start off overconfident with our capital raise. Then what happens is we start to experience some rejection. Now, when we start to experience rejection, we start to think about, okay, maybe I was a little bit too bullish, right? And it may take sort of 3, 4, 5 rejections, but we start thinking, okay, maybe I was a bit too bullish. Maybe I need a sort of different perspective on this. And then often we'll start talking to other people, right? And as we keep on sort of presenting to other investors, if we keep on getting rejection, then all of a sudden we have the next emotion. And typically that emotion is doubt, right? And then once the doubt starts to creep in, the next emotion that comes in is the more natural one of fear. Because typically at this time, as we're going through this, so this, in between this process, it could be weeks and months that are disappearing. At that same time, you could be burning cash, you could have other pressures that you're dealing with. So it becomes you become quite emotional about it and quite fearful, right? And this is the time when I said founders really sort of, you know, so if I use the analogy, sort of biting down on the mouthpiece and moving forward. That is pretty much our job as founders, is just to basically work through that and keep pushing forward, right? I said our job is to, no matter what the emotions we're feeling, is just keep driving our selling of our business forward. And then typically, as people start to feel like there's no, there's sort of no light through the clouds, then all of a sudden, an investor comes forward, and we're back to feeling bulletproof again. This is the typical emotions that we experience as we're going through the capital raising process. This cycle sums it up better than what you can imagine, right? So these are the experiences that you're about to feel. I said you can experience this all within 1 month. You can experience it across a 3-month period, but 100% you will experience these emotions, right? The overconfidence, the rejection, then starting to think about, okay, I need a different perspective, the doubt, the fear, and then all of a sudden, an investor comes through and you're starting to feel bulletproof again. This is absolutely, what you'll experience. Okay, now the other thing, if you take away 2 things from the webinar, okay, it would be simply this, is that the first thing you should be doing is massive action, right? And if you're raising capital, if you're thinking to raise capital in early 2020, right, then what you want to be doing is in January and February, you want to be attracting at least 50 investors into your deal room. Now, the reason why I actually mentioned the words specifically deal room is because what happens is people mistake sending an IM to someone as being interest. The reason I say deal room is because that means someone has actually made an action or clicked on an action to look at your investment opportunity. If they have done that, right, that is that is important because they've made an action to look at your information, right? And it's a numbers game. And said you need to have 10 to 40 investors in your deal room before you get 1 investor, right? So just understand the mathematics of that. When you start out, you think you're going to need to speak to maybe 5 investors and you'll have your capital raising done. That is not how it works. This is absolutely a numbers game. And as you go through the numbers, you get better, you improve and all that sort of stuff. But understand this is absolutely a numbers game, right? So the 2 things I want you to take away is that in the space of 2 months, you want to try and do your best to get 50 investors into your deal room. Number 2 is communicate with those potential investors 4 times a year, right? One of the challenges that investors typically face is that once they actually start communicating with companies is that they often get no information about it when the capital raising is done or when it's completed, right? Do your best to update your investors. Even if you perceive yourself not to be raising capital, do your best to be continuously updating investors. Okay, now on that note, okay, I'm going to go through some of my rejections, but I'm just going to leave this up there for a couple of seconds, just as there's still more and more people coming on. So just to make this absolutely clear, you need to get 10 to 40 investors into your deal room before you get 1 investor. Okay, so here's some of my rejections. Now I said this is never fun for me, but I think it's really helpful for you. So the first one is the most obvious one, right? And this is the one that most of us experience. Your valuation is too high. Right? Very rarely have I seen companies come forward and seen investors just go, do you know what? I think that valuation is absolutely spot on, right? This is a rare scenario. It does happen, but it's a very rare scenario. So your valuation is too high, is definitely one that people experience. Now, the reality is I've had people hear this many, many times and being still able to raise investment, right? But it's just a dance, right? I said, you need to understand, when you're getting feedback from investors as to whether this is the case and you need to modify or whatever, it's just a period of time and process. Don't reply to me. People get, for some reason, as founders, they get massively offended if investors don't reply to them. What you need to assume is if an investor has stopped replying to you and stopped communicating to you, they are simply not interested, right? Now, it's never nice, but it's just the way it is, okay? I prefer to go into Series A or earlier, okay? This is a common one. So maybe the stage at which you're raising capital is not the one which is suited to the investor you're dealing with. This is completely normal. Now, if you're dealing with investment groups, typically they have mandates, right? So they can only go in at certain stages, right? So that's what's important for them. And, you know, if you're not in that stage which they like to go in, then there's it's unlikely you're going to have a deal get done. That time frame is too short for me. So this is a difficult one because as a company, you want to try and manufacture pressure on your capital raise. You want to try and get it done within a certain time frame. But then you've got the investor the other side, which is they basically will want to work to their own time frame, right? And maybe it doesn't align, or maybe it does. I said this is the dance that you'll go through as you're going through this process. This one was, you know, offending to me because I've spent so much time trying to position myself away from this area, and we're not like equity crowdfunding at all. But this was a UK investment group that sort of highlighted that we were like equity crowdfunding. Now, I could not change their opinion, nor were they going to give me the opportunity to change their opinion or to explain why. And the reason I put this in there is because you're going to have that, you're going to have investors that have perceptions about your business and you can't change it regardless, right? And because that is their first impression, and often for them, that is what remains. And you'd have, as I said, and sometimes it's incredibly hard to change. This one's a nice one, and I always use the analogy of of online dating. Imagine if you're sort of using an online dating application, and then all of a sudden you have the partner you're trying to attract tell you, oh yeah, no, sorry, I'm not interested. I've decided to go with another guy or girl, instead of you. But I've decided to invest into another company. Always nice to get a little stab, in the heart whilst you're getting rejected. This was a frustrating one for me. I said I spent a lot of time someone sort of explaining what we do and going through all the different contexts. And then right at the end, they wanted to show me another business that they were involved in rather than talking about investing into my business. I said, this is completely normal. I said, I've gone through all sorts of, because of the position of WI and because of, who we have access to, I've gone through all sorts of random things. I had a group actually fly out. Actually, no, I'll go through that in the next one. Okay, but here is the business I'm involved in. So someone trying to steer you down another direction. This one, the same reason that someone gets a rejection for buying a vacuum cleaner, I also got for my investment opportunity, which was my wife is not keen on the investment. This was said, another great one. Just to, if I was feeling a little bit overconfident that day, that helped bring me back down to a balance. Why would I invest into you when I can invest into companies at seed stage and get a faster uplift? So going back to the stage at which someone likes to invest, I said, well, when you get these, I said, do I take them personally? Often not. It's more that it's just their positioning. All I read it as is, and this is as blunt as possible, is blah, 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 I'm not interested in investing. Whatever the reason is, unless they give me very specific feedback as to why. I said, if someone gives me specific feedback as to what they're looking for I take that on board, right? And then I basically look to create, as part of that, I look to create an FAQ for that. So one of the questions that an investor had was, how are we going to create velocity and virality for our platform, Crisp, which is sort of what I was discussing about. And, for me, that ended up becoming an FAQ, and it was something that I really thought about because that was actually a really good question. That wasn't the reason they decided not to invest, but it was a super good question during the discussions. Okay, now this one was, as I said, this group actually flew over from another country to meet with me. I lined up one of my largest shareholders to actually meet with them because I thought they were looking at a potential strategic investment. And then after flying here, after us doing some collaboration together, they, in that meeting, sit down and say that we can't invest in you as we are going through a capital raise ourselves. Now, I cannot explain to you what this is like when you're sort of got yourself wound up, you've explained to your board, you think some deal's going to happen, and then all of a sudden, I said, they mentioned to you that they're right. It's an emotional process and it's super frustrating, right? But it is just a simple, you've got to keep on moving forward, right? And then the last one, we don't like gingers. Now, just joking, I just throw that in there for comedy value, but of course, because it's a webinar, I can't see if anyone's laughing or got any smiles whatsoever, right? But you get the point with this. The point is you are going to get rejected, right? And it's really funny. We have an interesting experience from a wholesale investor perspective, is that when we deal with people, we've got a model in which we work and how we promote companies. And we found that when we're working with founders, that they either befriend or berate us, right? And they've all got the same objective, in that they're looking to raise capital, right? So from my perspective, I'm more diplomatic in nature. So I typically, if I'm dealing with service providers, I typically befriend them. That's just my nature. Whereas other founders take the berating approach. But really, all you're trying to do is get to the one thing. You're just trying to raise money, right? And you understand that this is a marketing game. This is a marketing and sales game. It's just people are far more emotional about it because it's their baby, right? And as all founders, the truth is that for every investor, you think about this, if you're going to meet 100 investors, you're 95 to 99% of those investors are going to think that your baby is ugly for whatever reason, right? And when I say your baby is ugly, they're not investing into you. They're rejecting you. So if you had that experience where you're getting rejected 99 out of 100, right, in real life, person, face to face, on a dating app, it's quite an emotional thing. But it is just, if you've got a background of business development, you understand the numbers game. If you've got a background of marketing, you also understand the numbers game, and that's the job. Our job is about sort of basically working through these rejections to effectively get to an outcome. Okay, so the core principles that we work on, that we sort of help with companies on their education part, is really related to, first one is get ready. Now, the reason I say that is because you said when I had Investec become a strategic shareholder, or become a shareholder in WI instead of 2016, we went through a process of 12 months, right? From the first time I met them to the time they actually invested was actually a 12-month journey. Now, the interesting thing is it actually really wasn't their fault. It was my fault, right? Yes, they did have a more sort of diligent due diligence process than what most other groups would have, being the investment bank and being an institutional investor. But the reality was, it was because I wasn't ready, right? I said, even though I'd been working in the capital raising space for so long, right, I didn't understand the detail of information required, right? And I'll go through that when I sort of take you through some examples of what sort of folder structure would be required. Stay ready. This is an important one, right? Because once you do get ready, you swear to yourself that you're not going to let this rest. And so for me, it took me a while to get our data room ready so that it was ready for a larger investor, right? And then as soon as it was ready, I was like, holy shit, I'm never going through that process again. I'm just going to keep it as up to date and as ready as possible. So stay ready is the next one, right? And that's really important. This is one, this is one that I've sort of, if I think about one of the biggest mistakes I made, it was this. It was stopping the raising process. So always be raising, right? And said, whether you're actually physically taking money all the time, what I mean by this is you always should be speaking to investors. If you are thinking about raising capital right now, right, and there's a likelihood that there's going to be multiple rounds to your capital raising, you should always be raising. Even if you have an investor come on board that gives you enough capital for a 2-year runway, do not stop the investor traction and discovery process, right? Because at some stage, I said, if you do that, I said, the process is get ready, stay ready, always be raising, because you do not want capital to be an issue, for you in the growth of your business. And I said, if I think about one of the biggest mistakes I've made personally, is this one, is actually stopping the raising. And it's amazing how many people, will really stop their capital raising because they're dealing with one investor. So it's absolutely nuts. Even if you're speaking to a large institutional investor that's looking to come on your register, keep speaking to more and more investors, because there is 1,000 reasons as to why someone will not invest into your company, right? And I'll go through the investor psychology towards the end, but you get the idea, right? So it's really important that, you always be raising. And then the last one is this. And so it's never good for our ego to hear the word no, but you want to get to a fast yes or no as soon as possible. And the importance of that is that if you can get to that fast yes or no, you know for yourself whether the investor is in or out for this round. Now, even if they say no, this doesn't mean that you stop communicating with them, right? It just means no for now, right? Now, there could be a milestone down the track, which helps trigger them to come back in. But it's really about, for you, getting your head clear about whether they're going to participate in this round or not. So getting to a fast yes or no, is really important. Okay, so now I'll go through the actual attitude aspect, and I can see that we're already 20 minutes in, which has absolutely disappeared. And good to, okay, let me just see if there's any questions on here. Hang on a second. Okay, nope. Okay, so next one. Okay, so first one is attitude you want to work towards, right? As a founder, is the power of one conversation. Now, the truth is, for us as founders, we could meet 100 different people, but the truth is one conversation can change the entire trajectory of our business, right? The challenge is we just don't know which conversation that is. So we have to have a lot to get to that one. Like for me, for example, Singapore, what we've been able to achieve in Singapore come from effectively 2 people, right? And those 2 people have been massive door openers for us in the entire region. And so I always help people understand that the power of that is just super important. So I've got someone asking if I can explain the form setup and content. So just so you know, Karen, I'll be going through that in the actual presentation about the actual structure of the data room. Okay, no today doesn't always equal no for tomorrow, which I've mentioned before. Network effect equals your greatest opportunity. I said you'll be, one of the things that I see now with more and more founders is that they forget the power of networks, is that they're always in the now, and they're not thinking about how the person they're meeting today could actually impact their life 5 years from now. Said that it's really, what's really interesting is the person that people that are making the most difference in my life and in my company right now are people that I met 7, 8 years ago, right? So network effect is your greatest opportunity. And then you forget those people have their own networks, right? So it doesn't matter how many people you know. I said it's always important to understand that. Said at some stage, and I said I cover this sort of in the next slide as far as not burning bridges. But network effect. So just think about it. When you are having a conversation with different people, different investors, just know that they've probably got 10 to 15 people in their network that are relevant to you. So if they like, trust, respect, and are impressed at what you're doing, then those networks will potentially open up to you. So it doesn't matter how many rejections you get, it's the one that can introduce you to another round of networks that can make all the difference. Okay, now this one's an interesting one. I mentioned to you that when people actually ring up the WIL, they're like, yeah, we want to raise 5 million. We want minimum check sizes of 500K, and we all want to do this in the next 1 to 2 months, right? Which is just completely unrealistic, right? And unfortunately, advisors sometimes have to go with this mandate because that's what they've got companies telling them. But I said, and then what happens is when they go to raise money and they have investors putting in 50K and 100K, they suddenly get disappointed, right? And the reality is, I said, what you need to see a 50 and 100K investment into your company as is keep me interested, right? Because often what we've found is if someone is going from that they don't know, like, or trust or respect you to investing into your company, there's a certain level of trust there. And then once they've done that, I said, there's an opportunity that if you keep hitting milestones and keeping they can invest significantly more into your company. I've heard of billionaires putting in $50,000 into businesses. And you think, why on earth would they waste their time, right? And the reason is because they want you to keep them interested, right? They want you to keep them updated because they're looking for, they'll have it in their head. They're looking for triggers, which will actually trigger them investing substantially more into your business, right? And it's that relationship, like, trust, respect. So never disregard the 50 or 100K investments because they are important. Consistent communication is a big one. Now, as founders, obviously we've got to build and grow a business, but understanding that as soon as you start taking on investors, communication with them is also vital, right? You've got to keep them updated as much as possible. It is time consuming, right? But I said, it is part of the journey, and you just got to understand that is part of your job going forward, that, all the other things that you need to do in your daily life, investor communications is also part of it. Okay. Observing from afar. You never think that it is just the people that you are currently speaking to that are watching what you're doing. There is always more people observing what your business is doing and what milestones you're hitting, right, that are not communicating with you. And for whatever reason, there'll be certain things that actually have them engage with you to make contact. You know, for me, a funny one recently has been actually from my LinkedIn activity. You know, I had someone reach out, you know, that sort of wanted to discuss about, you know, potential collaborate from literally from, you know, the different things, and completely relevant, right segment, right focus, all that sort of stuff, right? Not even yet a subscriber of Wholesale Investor. So there's always people observing from afar. And I said, it doesn't matter how long you've been in the space for, there's also still people that you haven't met and don't know yet. Okay, the more visible you are, the more opportunities you create. Now, this goes against one of the mindsets that we really had to alter at the start of Wholesale Investor was that, you know, a lot of people, you know, and it's typically driven by advisors and investors, they sort of set the mindset that basically, you know, you have to try and sell a secret, and it's just impossible. It really is, you know. So I would say for yourself, you've got to try and make yourself more visible, and then in doing that, you've got to create more opportunities. We deal with, I was actually at his wedding on Sunday in Singapore, but Hike, he likes to talk about the sort of area of psychology. And one of the most beautiful things he says is that our job as founders is to basically create serendipity. And when I thought that is pretty much the whole job of Wholesale Investor. You know, so we're manufacturing serendipity by the creation of opportunities. And that is our role. The more visible you are, the more opportunities that you'll create, and you've got to manufacture your own serendipity. Milestones trigger for investment. I've covered that before. Memories like elephants. Do recognize that. So I've had investors mention things about what they've heard from investor meetings 3 years beforehand. In Singapore recently, I had a meeting with an investor who asked me about how a company was going. They saw that company present 4 years ago, and they were curious as to how a company was going. It is crazy the details that investors remember about companies they're interested in. They are also patient and diligent. If you think that they are just sitting there waiting to throw money at you, you are obviously mistaken, and you'll find that out very quickly that is not the process. But they are very patient and diligent, and they will work to their own time frame. So as I said to you, this game of capital raising is a dance of you trying to manufacture pressure, and them also just doing their own, you know, going through their own motions before they feel comfortable to make an investment. And the last one that's most important is that it's all your fault, right? And said no one really likes to hear that, no one really likes to own it, but at the end of the day, it is. So whatever situation you're in, whether it be success or failure or struggling or working towards or whatever it is, it's all your fault, right? And what I've seen happen, a lot of companies that sort of come to us, and even ones that we've worked with, where they want to blame everyone else for them not raising, right? Other than themselves, right? I said, so, you know, if I said at one stage, I said, I've been through this situation myself where I was trying to blame someone else, right? And I realized it was my fault, right? I said, you know, whether you want to blame what you perceive as an advisor or an accountant or lawyer that hasn't helped do whatever it may be, it actually doesn't matter. And the reason why it's all your fault is because it's all on your shoulders. The success and this failure of your business is all on your shoulders. So ultimately, we have to take responsibility for it. All right. So to me, that's a really important one to know. And the last one is do your best not to burn any bridges. And this is the hard one, but I said it is absolutely crazy. This industry, it is so small. And I'll give you another example. The wedding that I was at on Sunday, I was at a table of 8. I'd only met one of them beforehand. So basically, out of that table of 8, there were 4 other people that actually that knew of Wholesale Investor, and I was astonished because I was in Singapore, right? I said I'm not seeing in Australia. I said I wouldn't expect that in Australia, let alone to expect that in Singapore, right? And so I said, do your best not to burn bridges because this industry is small. And I said I was meeting people from different countries that I knew one person that they happened to be connected with and know very well. Very, very, very small industry. Okay. It doesn't matter how many countries you're operating in, it is still super small, this space. Okay. And the last one that I'll try and highlight, and so I spent a fair amount of time on this, is not being ready is your greatest opportunity cost, right? Because what you don't want to be doing, and I said, I had this example where one of our investor subscribers, they're quite a large fund. They expressed interest into one of our clients, and they asked him a series of questions, and that company came back to them with answers to those questions after 4 months. Now, let me assure you, that investor is done and dusted. They will never deal with them again. I'm sure they'll be polite and friendly, but their trust in investing. If you take 4 months to respond to investors' questions, you are done, right? I said, if you take more than a day, I said, that is not good, right? I said, they understand you're building a business, but they also want to see that you're a professional and that you're ready. Okay, so here's our process for the 7 steps. Okay, so first one is your setup. Now I've got 3 different types of rooms that I've set up, and I'll show you through this. The first one is my pitch deck. Second one is financials, and the third one is a due diligence folder, right? And the reason for this is because I want a simple structure where what I've found is that most private investors will just want to look at the pitch deck, right? So they basically are happy to make this, and they're used to making their decisions off that. There are some investment groups that do want to go further into actually looking at some of the more detailed financials, like a history of the last sort of 3 to 4 years. And then you've got the other one where obviously there are investors that do want to go through the entire due diligence, right? So set up in the frequently asked questions. Now, frequently asked questions, said to me, has been one of the most important things. I've seen other people's deal rooms where they may have 1 or 2. You'll see with mine, I think I've got about 16 frequently asked questions set up in my deal room, right? And the importance of that is that effectively I'm just saving myself a whole bunch of time answering the same questions. You will find that when you go to raise money, you will spend hours and hours and hours and hours answering the exact same questions over and over. Your job is to set yourself up in such a way where you don't have to do that. Does this mean that you get more yeses because of that? So maybe not. Maybe they don't like the structure of your deal, whatever it is. What you're trying to do is save yourself time, right? And you're trying to get to a fast yes or no, right? I said it never feels nice, but that's effectively what you're trying to do. Okay, so the first step is after you set up your frequently asked questions and after you set up your different folders, and yes, I will show you examples of mine so you can give it as a reference. And also just as a note following this, we'll invite you to provide us with some feedback, and then as part of you giving us feedback, we'll actually be sending out the presentation to everybody. Okay, so the first step is to basically invite your investors. Okay, so when you're actually going through after you've actually set up your room, you set up your FAQs, the first thing you want to do is you want to invite your friendlies. You want to invite the people that are closest to you to actually start going through the process. So firstly is your board. Okay, if there's certain management that are very active in investing, then also you may want to invite them. You also want to invite your existing, and this is exactly in this order. Then you want to invite your existing investors, okay, to come to your updated room, right? And then you want to invite the previous people that you've spoken to. So one of the other things that I encourage every company to do is to build a registration of interest list of potential investors that come through, right? And just keep on adding to that list. And they're the people you want to communicate with 4 times a year, right? So the first step, invite investors, board, management, existing investors, and then also previous. Now, 1 second, I'm just going to have a quick drink of water. Part of talking for 30 minutes straight is you get a dry mouth. Okay, so point number 3, this is when you start going through the discovery and the attraction process. So the 4 main areas that we sort of tend to talk to people about is obviously you've got to discover and attract investors. You've got to manufacture that serendipity, right? So when I see things like demo days, when I see things like meetups, when I see all those things are activities or industry events, okay? Or obviously I mentioned wholesale investor events. I'm biased, but of course I'm going to mention us. They're all events that are about creating for you visibility. One of the things for us from a wholesale investor perspective is that we've found it easier to work with companies that have attracted some sort of media. There's an old saying in marketing that, you had to be basically, advertisers would tell people that they need to be seen sort of 6 times before people can sort of feel some sort of connection or some sort of trusting of a brand. Well, now that's sort of 14 to 15 times. The beautiful thing is we have social media, we have meetups, we have media, we have all, digital media that is, there's all sorts of different ways you can do this, but effectively what you want to do is you want to penetrate someone's subconscious mind. When they see your company, you want them, and this, so they may not be speaking to you right now, but when you make that contact with that investor, you want them to feel like they know you. In fact, if you want to put it as simply as possible, the job of us as founders is to move from being unknown to known. In fact, that's the entire job of marketing, right? The job is said, first one is to move from unknown to known. And then once you do move to that known, then you've got to go into like, trust, respect before a transaction, right? So all this is really important. The unknown to known is a massive part, right? So I said, it's been much easier for us to promote companies, even if those companies have gone through challenges. I said, it's just easier because people have seen that company name and if you've been around for a few years, it's even more helpful because I said, they'll feel there's more known, and then they can start to form their opinion. So make yourself visible, do your best to get media attention. I said media is part of it, and I said social media is also. I said it's not that hard to be active on social media, right? When I say social media, I said typically I've been most active on LinkedIn. I don't tend to use my personal social media for business, but for other people, that's their entire business, and fantastic. Use that as a leverage point. Obviously, don't break any laws in doing that. But I said if that's your mechanism, then fantastic. Industry events and just industry events are super powerful, right? Because if you can get industry recognition, it does actually make a difference when you're raising money. In fact, we find if we're looking at companies, when we're giving announcements, we like to acknowledge if people have won industry awards, that makes it, because it means the industry is recognizing that company. Or if they've got media attention, it's much easier for us to point to that media. And obviously they cover different things. When you start your discussions with investors, your presentation, etc., make sure it's efficient, brief, highlights the key important parts, and it sells the opportunity. Now, I say I'm only covering this quickly because there's so much more to it, but we will be doing further sort of webinars around this as an area about the actual presentation part, because it's really important. I said I've learned a lot myself in the last sort of 3 to 6 months on this part. But I said it's for what that actual structure looks like, but you've got to basically highlight what the problem is. You need to make sure that you're efficient and brief and get to the key highlights as soon as possible, and then you've got to sell the opportunity going forward. Okay, so here's my process. Okay, so these are my 3 different rooms that I've set up. As you can see, I've got the Wholesale Investor one on the right. This is effectively just got the pitch deck. Then I've got a financials room, and then I've got a DD room. Okay, this is what my DD room looks like, right? As you can see, I've got different documents in that actual DD room, right? But basically what it means, if an investor wants to ask, I've already got that information ready. Now, typically they are more strategic investors that want to see this, or VCs, corporate investors, and so forth. Private high net worths typically want to, if the pitch deck information is really, I suppose, if you can have a proper pitch deck, I said you can contain enough information in that for them to make a decision to move forward, right? And you said, in my case, 90% of the people I have dealt with have been satisfied with the information I've provided in my pitch deck folder. But as you can see, I do make it about. Now, if you look at the FAQs, now this one doesn't show it, but actually we've actually updated this section on our platform. Basically now what the platform does is I've set up all these FAQs. Now, when people click on these different questions, the platform, and this is the CRISP platform, by the way, if you're not aware, the platform actually recognizes all the different things that have been clicked on and actually moves that to the top. So you can see what are the most important questions to investors when it comes to your capital raise, and you can basically answer them one after the other. But it just really, I said, for you, it just helps you put into context what they're most interested in. But setting up a decent amount of FAQs will save you plenty of time of communicating the exact same thing over and over. I said, whilst you may be thinking they're talking about, oh, I'm going to set this up so I can raise capital for a few months. I'm talking about setting this up so that you can be effectively always raising over the next 1, 2, 3, 4, 5 years, and just keep on updating these FAQs. Okay, so activity tracking is an important part. And when I typically do workshops, I ask, how many people actually track their activity. And it's amazing, or even have any email tracking software or document tracking software. And it's honestly, it's less than like 15, 20%. And that blows me away. How I knew Investec were interested in my deal was every email I sent them relating to documents for WI was being opened anywhere between 50 to 60 times. That's how I knew their level of interest in my opportunity, right? And that's where you need to get to. Momentum creation is actually one of the hardest things to create. And I'll go through the investor psychology, but you'll understand why. But when you're raising capital, you want to generate as much momentum before you launch the capital raise as possible, right? And then manufacturing pressure is part of that process. So often you'll see people put deadlines and timeframes on their capital raise, and that is for that purpose. If you look at corporate finance houses and investment bankers, This is where this is what their real skill is their ability to how they can actually generate momentum in a capital raise, put a time frame on it, and then create all the pressure and get everything done towards that time frame. And you will know a lot of them actually work through day and night to get deals done based on that time frame. Now, the truth is, in the private capital raising space, sometimes that is really difficult, right? And I said it's a skill in being able to do that. And it's also a dance, because you want to give an investor enough time to make a decision, but also you want to have pressure that a deal gets done, because I said, if you give too much time, they will take it, right? But obviously you want to get the money into the company. Communication, as I mentioned before, be active with your communications at least 4 times a year, but be communicating before, during, and after the raise, okay? And then I mentioned about the rolling close. I actually learned this in the UK. The rolling close effectively just means you just keep on moving from one close to the other, right? And so the actual biggest challenge in doing the rolling close is more the legal part, right? So if you've got in your shareholders agreement that, you know, your shareholders need to sign off on it, for example, that's a time-consuming process, and it's also expensive going through it, but it's often what is required. But the rolling close is one of the best ways for you to maintain momentum. Okay, so here's some activity tracking. So I just basically updated this, but here you can see, you know, here's what I can see when someone's interested in my opportunity, right? So this is actually a screenshot from my platform, but you can see what people are doing, and every activity that an investor does inside the Crisp platform gets scored, right? So I said, your job is to drive people to the platform, right? And get people interested. And then after they go in there, then you can see everything that they do, right? And you can track all their different activity. But at least for me, I know how engaged someone is and how genuine their interest is in an opportunity. If I've sent someone a link and they've logged in and then they haven't looked at any documents whatsoever, I know they're actually not really that interested. However, if they go and click through absolutely everything, even if they could still say no, but at least I know that they were interested, you know, and I know what level of that interest was. They may participate in another round, who knows? Okay, here's an example of someone which went basically clicked through every document and also clicked through every FAQ item. But the important part for me is that I can see it. I know it, right? I know what their interest is. And often, so one of the investors I spoke with, now they didn't end up investing, but effectively because they spent so much, they went through absolutely everything. My conversation with them when I spoke to them went for 8 minutes. Right? But that's because they viewed absolutely everything within the platform before I actually spoke with them. Okay, so I hope that sort of is really helpful. Now let me just see if there's anything on the question front. Nope. Okay, I'll keep on rolling. Okay. Now I said, just so you know, you can actually ask questions, and I'll do my best at the end to go through as many questions as possible. I've got Patrick on our side sort of managing the questions. So, you know, I said, feel free to ask questions in the Q&A section. You know, and I said, I'll do my best to actually go through them. Normally when I actually do this in a live format, I actually make it engaging and people can ask questions, and I sort of, you know, go back and forth. So anyway, feel free to use that Q&A if you have any questions. And I said, I'll do my best to not to name who asked questions. If you want to remain anonymous, if you're happy to mention your name, I'm cool to do that as well. Okay, so the investor cycle, so this is really important, right? So now I've gone through your psychological process, I've gone through your setup, I've gone through all those different parts. Now what I want you to understand is what the investor's going through, right? And I learned this all from Hike. Hike was the best one to help me sort of understand this and then put it in a context in which, you know, I suppose other founders could understand. But the first one is you've got to understand that when an investor's dealing with you, their natural first thought is loss aversion. Now straight away you're thinking, okay, they're worried about losing money. Well, actually there's different ways someone can experience loss in dealing with your company, right? So there could be loss of money, obviously. It could be loss of face, right? It could be loss of credibility, right? Or it could just be loss of networks, right? Or loss of relationship. It could be other things that they're actually thinking about. But the first step is really around that loss aversion part, right? That's the first step in the investor psychological process. The second part is that when you're dealing with an investor, no one wants to be the first one in, and then no one wants to miss out, right? So this is when I talked about before about creating momentum is one of the hardest things to do. this is because of this. Investors do not want to be, as much as they love what you're doing, they just don't want to be the first one in, right? And said they also don't want to miss out. Bandwagon effect. The story that I use for this, and I think it's the most perfect example of it, was a company called Shoes of Prey. Now, most people have heard it, and they've obviously, I believe they recently, actually, I think they went into administration. Yeah, they recently went into administration. No, it was another one that got bought out. But anyway, but I remember their story so well because they went through this journey of they were trying to raise capital for like 2 to 3 years, and they were just getting knocked back by pretty much all the VCs, investors, and so forth. And then Mike Cannon-Brookes invested. He was the one that decided to lead. He was the one that went in first. As soon as he went in, right, and then it was Bill Ty, I think, also went in at that same time. Because those two led, everyone else followed, and then it was suddenly a bandwagon effect. Now, if you notice, when you actually, and you'll notice this more and more now that I've mentioned it, when you actually see articles come out from all the different media groups about companies raising capital, you'll notice that VCs will typically invest together. Well, so do high net worths. High net worths typically invest with their mates. They've got mates that they've been doing deals with for the last 10, 15, sometimes 20, 30 years, right? And they often do deals together. So that bandwagon effect is super important because once you get one in, others are likely to follow, right? Because then it leads on to the next one is that if you start to generate that momentum, then they're worried about FOMO, the fear of missing out. Because if this other person has gone in and they don't go in, then they're likely to have missed out on the opportunity. So fear of missing out is another important part. And that's where that dance of manufacturing pressure is such a hard thing, right? So bandwagon effect is really important, right? FOMO is really important. I said, this is a dance. So you start out loss aversion, then they don't want to be the first one in, then they don't want to miss out. Then you start generating momentum, you start to get bandwagon effect. And at that point, that's when you start getting closer to the closing year round. And then it's worry about fear of missing out. And then if you've done a really good job, then you have the issue of scaling back. And then if you've done such a good job that investors are upset at the scale back process, then that is the best situation that you can be in, right? But ultimately, I said it's really about how do you get to that point? How do you generate as much momentum as possible? Right. So I know people go up and talk about, about how to choose the right investor for you and so forth. I said, when we're dealing with most of the companies, 90% of the time, they just basically are looking to get money in. And I said, never discount that 50 and 100K because often what happens, what I've seen with companies is they're raising money from private high net worths for 50 and 100K. At the same time, they're working on larger institutional money or larger investment amounts. Right. And that is what really sort of, gets that growth driving for that business. I do understand that when an investor deals with you, they're thinking about how they can generate 5 to 10x with your actual investment. And then the other part is one of the easiest areas for us to raise money for companies is typically when they're pre-IPO because there is some sort of expectation of an uplift as they're going through that capital raise. So I said that's really important to understand those different aspects. So I hope that was helpful. Okay, common mistakes, and I'll be as brief of this as possible, right? So first one is I mentioned about the reliance on one existing investor. I said I made this mistake myself. I've seen many people make it. Just because you have one existing investor in there that said they're going to, it doesn't mean that anything can change at any time. Like I'm literally saying that tomorrow they could get news about one of their other investments and that changes their perspective on you. No matter how strong your relationship, no matter what you've done previously, I said reliance on one existing investor is not possible, right? Next one is relying on one potential investor with no time pressure. This is another crazy one that we see all the time. People stop speaking to all other investors to deal with one potential one, right? Even though there's no time pressure involved. I said, it doesn't matter. You've got to keep on generating momentum because if they say no, or let's say the other thing, they could say yes, right? But maybe they don't invest the full amount. They could have been starting out talking to $1 million, but they only put in 100K, right? And then you have to keep on going. At all stages, you've got to keep on generating interest in your capital raise and you've got to have several irons in the fire as part of that. Okay, overconfidence and unrealistic. This is a common one that we deal with daily, okay? But so just understand, so it's a mistake that all of us make and everyone will make. Waiting until the raise is launched until you actually start raising. I said, do your best to build up in the months leading to actually start raising. And then too much trust in advisors. Now, I say this in a way and said for the advisors, and I give context is for the advisors that are actually on this, and what people that are listening to this webinar might find interesting is that when we've done these workshops, typically we find that the audience is about 60% sort of founders and CEOs, and then the others is made up of investors and actually advisors. So for the advisors that are actually on the call, the reason I highlight the too much trust in advisors, whoa, hang on, that's not where I wanted to go. The reason I highlight that is just because I said I've made the mistake before where I said I just put all the trust in the advisor, didn't monitor what they were doing, and had no visibility over their activity. I said, and you know, they were unable to come through with the actual capital raising, but I didn't find out until I said a time when it was not ideal, right? So I said you've got to basically work with them. I said, but ultimately it's all your responsibility, right? And I said you've got to have visibility over those actions. Okay, now actually, I won't leave that up for too long. But basically, with that feedback, we're actually so following this, I'm just going to go through a couple of. So following this, I'm going to send through a survey feedback to get some feedback on the presentation and any ways that we can improve it and so forth. Then I'm going to send through a link for everyone to basically set up a free CRISP account. And then also we're going to basically mention some information about sort of what's coming up with Emergence 2020. Now, you would have seen some of the screenshots in there in the actual presentation, and they were related to CRISP, right? So obviously, CRISP is a platform we built. We launched about sort of 4 or 5 months ago. We've had really great take up from companies on the platform. We're now going about the promotion of starting to promote them, and now we're seeing companies actually inviting their investors into the platform and so forth. And I said, we're basically now at V1 of where we'll end up being with the actual platform. So there's lots of new things that are actually coming. But effectively, the reason why we built CRISP is that when I've looked at what's been happening over the last sort of 2 or 3 years, I've noticed there's been a lot of frustration in this actual area. Effectively, we're dealing with a fragmented ecosystem from incubators, accelerators, co-work, all those different groups that are highlighted there. Everyone's working incredibly hard, but the problem is everyone's fragmented and no one's really sort of collaborating. So we wanted a platform that we could build, which was ecosystem first. Also, we wanted one which was, instead of using isolated solutions like sort of, Excel spreadsheet or email or, using a virtual data room one side or using Google Drive, it was just basically an all-in-one encompassing system which could basically manage the entire process. And, a setup in which you could either have one document in your deal room or you could have a full data room. It was up to you, right? We just wanted something there where there was flexibility, there was options, there was privacy, there was an option to be visible, there was an option to be invisible. Whatever founder wants to do, we wanted to set it up so that you can control the actual process. Reliant on existing networks, which is always a harder one. As I said, founders typically have no visibility over their process. And this one's just the managing of the capital raising via email and spreadsheet. The last part that I just want to highlight is that what I really learned for myself is that when you're actually going through the capital raising process, you're effectively spending an incredible amount of redundant time and money on processes, right? I said, because people just don't know another way. It's like the FAQ. If you literally just bought CRISP and just use the FAQ part, you get your money, because the amount of time you save, the opportunity time you save in answering the exact same questions over and over and over. I said, you don't feel it. I said, but it's absolutely there. Once you set it up, you don't feel it, but it's absolutely there. And I said, that's what we want to do. Our job is to help companies save time, save money, and improve the efficiency. And I said, I'll tell this to anyone that will listen to me. I do not understand why online platforms deserve 6 to 8% of capital raising fees for an online introduction. I said, I know that's the equity crowdfunding setup. And I said, if you haven't listened to my presentation of, capital raising sort of 3.0, I talk about what I see the future of capital raising is. Now, to me, that is the 2.0, but it's effectively advisory with a website. And so if you work with advisors, good quality advisors, and you see the value they add to a transaction, it's one of the most impressive things that you'll see. And I credit advisors that I've worked with, for helping us transform our business because of the advice they gave, right? Online platforms do not deserve 6 to 8% for an introductory fee. So basically utilizing CRISP, the idea behind it, I'll just keep this really simple. And then obviously, and I'm going to encourage everyone now, if you've got any questions, whilst I'm just going through this, please write in the questions you want to ask. And then after I've gone through this, I'll go through any questions that you may have. But effectively, the way we've set up CRISP is just going to be a one-stop shop for the capital raising process, end to end. The visibility and access is completely controlled by you. The privacy is controlled by you. You can decide whether you want to be positioned in the investor marketplace or in our investor hub, or if you want to be completely private. Companies said a lot of companies just set up and use the pitch deck folder, which I said, even on the free setup, you can actually put 5 documents in there and use that for your capital raise. But as you would have seen, the way we've structured the deal rooms is it's effectively structured in such a way in which the way investors want to see information. We collaborate. Basically, I learned this from Australasia, who's one of the world's sort of leading data room providers. I said we've actually got a joint, a two-way channel partner relationship with Australasia. But effectively, their structure. I said that structure of deal room is the way which investors expect to see information. Lead management, all that sort of stuff is done through the platform, right? So we've done our best to make it as simple as possible for you, but I said it's hard to describe until you actually, I said there's 2 parts. When people use this, okay, they're obviously, the first part they want is they want us to drive investors to it. When you actually get their real value from the platform is when you actually start driving your own investors to the platform over and over and over again, right? I said, I do my best to try and drive between 5 to 10 potential investors to my data room, every 2 weeks, right? It's basically what you got to consider is that generating investor interest is now a KPI for you. And your job every single week is to be generating investor interest to your business and thinking of ways in which you can actually, in which you can actually do that. Here's some examples of the Investor Hub, just so you get an idea about what we've actually set up and how investors can actually set their preferences. We've actually used the GICS code for it. Investors get matched. The circle is slightly off. Investors get a preference score on a match with a deal. Then they get explained why they're actually matching with a deal. So we're also trying to make it easy for investors as well. Now, obviously, so what we're doing for companies that utilize CRISP as a starting point, we're actually promoting them to the Wholesale Investor database as we're building out the user base for the CRISP platform. And then some of the features we've got coming is that you'll be able to do all your investor relations communications through the platform and also track that. I said, please keep on asking questions. And said all this other stuff we'll be building in the meantime. So the next 3 to 6 months, you'll see these being released. One thing I do want to talk about, just sort of as we're sort of finishing up, and just before I get into the questions, is emergence. A few people would have seen it. We've now just crossed, I think it's like 730 registrations for emergence. So basically, Feb 26 to Feb 28, we will have between sort of 1,500 to 2,000 investors, industry, founders, etc., basically at our emergence event. Emergence is the largest thing we do each year. Last year, we had delegates from 9 different countries coming along to the event. If you haven't experienced, it's one of the most incredible things. Like the deal making which gets done from this is incredible. I said, out of everything we do, this has like 10 times the impact because of just the whole feeling for the event. So, for companies that are raising money, that are basically in the growth stage, emergence, I would highly recommend, so we will send some information about it and we'll encourage you to register interest. But effectively, emergence is such an incredible platform. And I said, the way we do is we promote companies in the lead up to it, and that helps us in the attraction of investors. And then as part of the way we do it from a company's perspective is we've turned into an experience. So for companies that are raising money, we're going to be doing a whole bunch of work in the lead up to it about how you actually get ready to present yourself, the presentation, pitching, the communication templates with investors. We've got a whole sort of customer success program that we've set up for this. And then actually at the event, you can have a trade table across 2 days for it. You obviously get the opportunity to present to the investors at the event that are coming along. And given the size of the numbers that we're expecting, I just don't think there's a larger event in Asia, really, in Australasia, where there'll be this many investors, in the audience at one time. And then at nighttime, we host private cocktail functions because basically the way it works for the formalities of the day lead to a much easier relationship building and deal making at nighttime. And also we've got a special VIP room that basically the companies participating in are allowed to go through. They're allowed to go through and basically request interest in your business and discuss with you more about it. So really that's what we're looking at from the emergence perspective. So we'll send some information about that and you can register your interest. Now, I'm going to go through the questions that people may have. So just give me 1 second. Okay, Mr. Anonymous Attendee. Basically, they've asked what is the cost of using CRISP. Basically, CRISP is done on a SaaS basis. So for companies that are ESIC approved. Effectively, it's billed yearly, but effectively works out to be $100 a month. So it's effectively $1,200. And if a companies that are growth companies, then effectively it's $23.88 per year. So effectively $200 a month, billed yearly, and I said it's for what you would normally spend in a capital raising process. It's actually it's quite inexpensive for you to use. Yeah, so $23.88. Now feel free to ask any more questions. Okay, so if there's no, whilst I'm waiting for some more questions to come through, basically there's my details. You can add me on LinkedIn. Obviously, just do it as Steve Torso. That's one of the easier ways to actually do it. You can obviously email me directly. And to set up your free account on Crisp, just simply go to crisp.io and then you can set that up. As I said, following this webinar, we're going to be sending through an email which will do two things. So we'll ask for feedback on the actual presentation. If you have any more questions, feel free to send them through as well. And then after you send that through, we'll provide a link to the actual presentation and also to the recording of this webinar. There'll be a link for you to set up a free Crisp account. And then also there'll be a link if you want to find out some more information about Emergence 2020. I said the job of this even if you do, now just as a final summary for this, my real hope in doing this is I want people to get as much value as possible. And I said, I've gone through many different frustrations, many ups and downs in this journey as far as building a business, raising money and so forth. I understand the pressure that you feel as you go through this. And I said, the job is, how can we do whatever we can to help you, save time, save money, improve efficiency, but actually raise capital. So, I hope this has been really helpful for you. Said, any more questions? I said, I'll give you a minute to write down any more questions. If there's no more questions, then obviously we'll end the conference call, but really appreciate everyone's time. Okay, so someone has asked, do we have any? Yes, we do have team members in Perth. So following this, please do email me directly. The person that asked this question, do email me directly and I'll provide you with an introduction to our Perth team member.